Hey guys, Spencer here. Today we're going to be doing something really exciting, and that's going to be doing the Monte Carlo simulation on the efficient frontier. Now before I begin, please make sure you smash the like button and make sure you subscribe for further notifications. So why do you care about the efficient frontier? Well, in this case, if you want to make money or just save your money, then utilizing this particular technique is almost like foundational in order to accumulate your wealth. So back then in the 1950s or so, there was this really smart guy, Harry Markowitz, that popped up, and he's the one that constructed the idea of what we now know as the modern portfolio theory. He's the man that identified very clever ways to find the optimal portfolio for the most risk-adverse investor. He did this by looking at the expected returns and then essentially counting in the fact of the volatility of a given stock, and he denoted that as risk. So I'll be walking through what I did in terms of my simulation via Python. I'll be doing this in Jupyter Notebook, so feel free to follow along on a different computer. And without further ado, let's get down to it. So I went ahead and I created a notebook. Everything's already pre-coded and pre-written. So I'll be doing a live demo here. So a real quick summary of what the efficient frontier is. It's essentially risk as defined as the asset's actual return differing from the expected return. And we will be looking at the various weights, and we're going to have a great visualization at the very end of this demo as to what the efficient frontier should look like. And we have our Harry Markowitz. Gotta give credit where credit is due. He won a Nobel Peace Prize as well for his modern portfolio theory in 1990. And so I chose about 10 companies to be exact, to model what this efficient frontier would look like. Typically in a given portfolio, for like a typically like diverse portfolio such as like the S&P 500, you would have 500 different companies. But in this case, for simplicity's sake, I will be using 10 companies. And I chose these 10 companies, Google, Nvidia, Facebook, etc., because they were sort of not really correlated with each other. We have tech companies, we got bank companies, health companies, we got consumer-facing companies, entertainment companies, transportation companies. So hopefully that this represents a diverse type of a portfolio, but in realist terms, like a more diverse portfolio would be like growth and value type companies, but we can get into that a little bit in a different video down the road. But these are the companies I will be simulating the weights on. These are the packages that I will be using in re, string O, time delta requests, etc. Python packages in general. And this is just an overview on what we got going here. I created a really neat function that will scrape data from Yahoo Finance. In this case, I'll be getting data from October 10th or October 11th and all the way from 2013 to 2020. So it'll be about 7 years worth of data. This time range, I wasn't really entirely picky, but around 2013, this is sort of when the market started upticking from the Great Recession, from the 07-08 crisis. So this is when the market started to go back up. So that's why I chose that particular time range. You can also use 5 years if you so choose. And then I just convert it into a data frame. And I just append the names over here. So let's run this real quick. And it'll be getting 7 years worth of data with all of our companies over here. And this is just a tail. So we have 1,700 observations. This is our most recent observation. So October 9th. So I'm recording this on a Sunday. So the last trading day was a Friday. And this is October 9th of 2020. And this just gives you the closing time or the closing value of that particular given equity or stock. So good. Once we have our data denoted as D for data, I'll be splitting this into a training and testing set, where my training set is going to be related to my simulation. So that is where I'll be extracting the weights. And then the testing set, I won't really use that for weight training, but I'll be using this as a judge of how well our portfolio has done if we have invested 1 year back in the past. Yeah. So I will run this real quick. Got my training and testing sets. So I have the data dimensions where 1 year, 1 year's worth of data is about 252 to 251 trading days, and then all the other days are counted as weekends or holidays, etc. A really quick example of what this data looks like, I went ahead and just typed out what that output looks like. So our testing is going to be our most recent 1 year's worth of data. So our most recent trading day, which is Friday, October 9th, and it will go all the way back to whatever that number is, 1 year's worth of data. And then our training set is going to pick up from that particular value. So we just picked it up 2019 1010, and then get the next 6 years worth of data, since we have 7 years entire worth of data to play with. So we have 1010 over here, and they got 1011, so it just picks it up. And then we'll just be using our test to evaluate how well this efficient frontier, modern portfolio theory, etc. has worked out. Cool. So next thing we want to do, we want to understand the returns. So I went ahead and I calculated the daily returns. So just d dot percentage change. It's essentially the day-to-day percentage change, whether or not you increase like a percent or you lost a percent of your entire value related to that given stock. So I calculated the percentage changes. I got the column names over here, and then I annualized the average rate of return. So this is the way I did it. I essentially just obtained the means that we calculated over here. I got the entire expected returns, and then I multiplied it by 250. So I multiplied the expected returns, the average expected returns, multiplied by 250, which is our annualized or our expected value for our expected return. And that's how we would annualize our average rate of return we have going on over here. And then I'll just transpose this value for easier calculations down the road. So essentially our DAR here, which I called DAR, is essentially your daily average return. So it's essentially the percentage change from day to day for each of your stock prices. So it'll be like some percentage change from one day to the next. That's all it's doing over here. And then we have our geometric average rate of return, or as you might know as the compounded annual growth rate. This is in general a lot more accurate than just utilizing your typical arithmetic average. I'll go into depth as to why that is true. And then I essentially just concatenate our average expected returns and our geometric average returns, and we're going to have some value at the very end, which looks something like this. We have our average arithmetic returns, geometric returns, and then this is the expected annual returns, which was the expected returns of AA, which was our 250 times our average for our expected returns. And so that is our expected returns on that, and then we'll be utilizing this for our Monte Carlo simulation. And then these are just for reference what the DAR looks like. It is it's, as I was saying earlier, it's essentially just the percentage change from one price to the next price on a day-to-day basis. Now, one of the key reasonings I wanted to get into more depth as to the difference between the arithmetic return and the geometric return, and why you should use geometric returns if you're chit-chatting with your buddies on how well you've done from a year-to-year basis. So I'll give you the example over here. So example, returns are the following. You made 50% in your first year, 30% in your second year, and then you lost 50% on your third year. So what is your return? Right? So this is one of the reasons why you should not be using the average rate of return, because if I start with $100, right, and I gain 50% on the $100, which is $150, you gain another 30% on your $150, which is $190, but then you lost 50% of your money on your third year, which is 97.5. So the arithmetic average would dictate that your average rate of return is 10%. That's not true, right? Because you started off with $100, and at the end of the third year, you have 97.5. So that's how that's how it gets kind of funky with utilizing certain types of metrics. And so this is why it's a little bit more accurate to use your compounded annual growth rate. So you essentially just get all of your returns, so 50%, 30%, negative 50%, you add 1 to it. So you get 1.5, 1.3 times 0.5. You raise it to however many periods. In this case, our periods are years, so it'll be raised to the 1/3. You subtract it by 1. And then our expected compounded annual growth rate is that number, or negative 0.84%. So this is a lot more accurate as to how you've performed in the market, and in general, this is the sort of like the standard in order to evaluate how you've done compared to other people as well as the market. Now that we have our definitions out of the way, let's go for a little bit more definitions, but this is largely related to our algorithmic process that Harry Markowitz has so kindly published in his Journal of Finance. And so he has 3 main criteria that he essentially uses for his overall evaluations on what is the best portfolio to have. Our first one is going to be the Sharpe ratio. So this is essentially, you have your return of your portfolio, you subtract it from a risk-free instrument, and then you divide that by the standard deviation of the portfolio. So the return of the portfolio is just going to be like your return, right? Your compounded annual growth rate of that given portfolio, for instance. Your risk-free rate is essentially the government bond, like a 10-year, 20-year, 30-year type of a treasury, because we automatically just assume that the government is risk-free, the United States government is risk-free, and its word is gold. Otherwise, our entire economy will collapse and we just have Armageddon. And we will be worried about other things besides our portfolio, for instance. Our standard deviation of the portfolio, so let me give you an example. It's essentially the difference between your average and some value that it fluctuates from. So let's say our average is 100, and it fluctuates between 105 and 95, those two values. And 34% of our values reside above 100 and the other 34% reside below, and that is one standard deviation. So you can think about it as the fluctuation of our portfolio going up and down. But a more accurate idea on how to measure volatility is through this equation. We essentially just have our weights, because our weights of our portfolio, so how many dollars do we put in a given company versus another company, like $5 in company X and $2 in company Y. And then we just measure this by multiplying the weights by the variance covariance matrix, and that's our volatility. So to put it in more simplistic terms, volatility is just the zigzag motions of the stock market going up and down. That's volatility. Very noisy. And then last but not least, we have our expected rate of return. Very simple. We just multiply our weights of our portfolio and then our return on the given portfolio. That's it. So we essentially just use these 3 values, and then in order to simulate our overall weights in our portfolio. So I would say a little bit more in depth here. I got 3 arrays, got returns, we got volatility, we got the Sharpe ratio, and then this is what's going to be randomized, our stock weights, so that we can determine how much money, or how much, like what percentage of $1,000, for instance, do we put into our given individual stock. Okay, I'll be iterating this through 100,000 times, or 100,000 iterations. The number of assets that we'll be going through is the tick size, which ticks or tickers is essentially just the name of our company. So for instance, if we have, right here, Love, PFE, Coke, Cat, that is the ticker symbol for a given company. So LUV, that's Southwest, PFE is Pfizer, so on and so forth. Okay, and then I calculate the daily return so that I can get the annual returns. Same idea what I did earlier, multiply by 250 times the overall average of our given daily returns. Add 1 to it, since we are going to be comparing like a 1.01 I guess additive, or a 0.99%. So we have, like, let's say we have $100, and our return for the day was 1.02 or 2%, right? We just multiply by 1.02 by the 100, we have 102. Something very similar for if we lose money, like 1% of our money for the day. So our $100 becomes 99. So on and so forth. So that's where the +1 comes into play, so that we can take into consideration of the negative values, negative, right? It's not really negative, but it's like a percentage change. That's what we do there. And then I calculate the covariance. We have a really neat function, cov, that's it. And then we just annualize that by multiplying it by 250, and then we have our annual returns. That looks something like this. So in the past, I think it was like 6 years that we're working with. Google in the past 6 years for the annual return is 19%, Nvidia 50%, 26%, etc. So these are all of our annual returns that we'll be working with here from the past like 6 years, sorry. So we'll be using these annual returns over here, and this is where the entire simulation happens. So we are going through the number of portfolios we have, which we denoted over here as 100,000 iterations. So 100,000 times we are always going to be having a random weight to that given assets. Okay, so we have our randomized weights with our given assets. We standardize the weights. So like we have, in this case, we have like 10. We have 10 companies, right? And so within these 10 companies, we have to decide how much of a weight are we providing for each of these companies within the 10. So 30% for X, 10% for Y, 2% for Z, and then, I don't know, 1% for D, right? I mean, it really just depends on what these weights are. And then we multiply the randomized weights with our given annual returns. And then we calculate our volatility from all the equations that we provided earlier, calculate the Sharpe ratio. This will become very important later down. We calculate the portfolio returns. We append it to our list that we have initialized over here. And we do the same for all of our other stuff, like volatility and our stock weights. So let's run this real quick. It'll take like a few seconds. Yep, and that's done. So once we have finished that, we can now get a really nice data frame on what this looks like. So these are all simulated values. From our given simulated values, we calculated our Sharpe ratio, and here as well as referring to as the weights. So for our very first observation, we have 11% as part of Google. We got Nvidia, we got 15% a part of there. We got 6% for Facebook, 10% for Wells Fargo, 90% of Disney, so on and so forth. But all of these values, all of these weights are simulated, and this provides somewhat of a return on what we have expected in the past and what that given volatility looks like for that particular given weight. Cool. Now let's look at what that efficient frontier looks like over here. So we have somewhat of a curve going on here. There are 2 points that I want to point out, and I did that over here. It's essentially finding the best, the optimal solution. So if we are an adverse risk type of a person, like we don't want any risk, right? We absolutely hate the idea of potentially losing money. Then we want to go to this blue square. But if we love risk, and given our specific portfolio that we have over here with our chosen 10 stocks, this is what we are expected to achieve in terms of return. So like a little bit more than 30%, and for a volatility of 20%. So it'll fluctuate 20% of the time of our given price. So if we are really risk savvy, then we will choose the red area, and if we are not risk savvy, then we would choose a blue. Okay, so our next step, we want to see what type of weights are associated with our current values, and I have that over here. So our minimum risk adjusted values, our expected return 15% for our minimum risk adjusted, and this is our Sharpe ratio, the volatility, and these are the weights that we have over here. Same thing for our maximum risk adjusted values. Like for our maximum, we have close to 31%. Volatility, a little bit higher. Sharpe ratio, a little bit higher as well. And we have a different weight schema associated with this. Now that we have calculated our weights from our minimum risk adjusted values and our maximum risk adjusted values, we can now sort of apply this to real life. So if I were to invest $1,000 last year, right, how much money would I have expected to gain up to today? And so I wrote a little bit of code on what this will look like. Just run that real quick. It was very fast. So I'm going to scroll up here. So my expected rate of return for my minimum risk adjusted values. So this is taking into consideration of this, our minimum risk adjusted values for our given weights over here. If I were to put all my money, right, all my $1,000 into these given weights, so 1,000, so I'll put like $35 into Google and $18 into Nvidia, $197 into Disney, etc. I would expect to make 11.5% return on my investment here. So I'll be making $151, which is like, that's pretty good, right? For our maximum risk adjusted values, I'll be expected to make $309 on my $1,000 investment. That's also pretty good, but do take in mind that maximum risk, right? We are more susceptible to the fluctuations of the market. So this might as well be like $700, right? Or it could be $700 as a result of us. Now that I have invested $1,000 in the past, right? What would I have expect now in the future? So this is where the application comes into play. So assuming that I put $1,000 into these given weights, like I put $35 here, $197 there, to the T, right? I would have made or lost, in this case, I would have lost $11 if I were to follow the minimum risk return. And I would have made $450.86, right? If I were to put all my money into the weights that I have over here, right here. So if I had $1,000, I would have $106 into Google. I'll have $251 into Nvidia, etc. And so if I were to like divvy out my money in that way, I would have actually made that much money. So do take in mind that this is not entirely accurate, right? Like not always will we have, if we have the maximum risk, we're going to have a greater rate of return, right? That can be like the opposite. Like if our risk was a lot more than intended, like in terms of the market, how they viewed that particular stock portfolio or stocks in general, this might as well like be all the way down. Like it could have been, and that's just more susceptible to the actualities of the stock market. And also related to the portfolio weights of the minimum risk associated with the portfolio, like $989. Like we all know, this past year has been like one bumpy ride, right? You might have sold some stocks, you might have gained some, gained some value in stocks. But yeah, with all that has been happening, if you just wanted to make sure you retain your money, $989, it's not that bad. So if I was the risk adverse type of investor and I put $1,000, 1 year ago, $989 is not that bad. Like there are people who have lost a lot more than that, and this is taking consideration that you don't sell anything or you don't buy anything further. But if my maximum risk return portfolio would have, if it went bad, it would have really went bad. Like it would have went really down. So instead of $1,450, that could have been $500 left in the bank, losing 50%. So do take that into consideration as well. The companies that I have used in this stock example have historically done very well. For these examples that I've used, probably skewed more toward the riskier side. But if you want to look at this a little bit more, I do encourage you to take a look at the broad S&P 500 index. They have 500 companies there. So if you want to sort of maybe potentially beat the market, start cherry picking these values and then run it through the Monte Carlo efficient frontier simulation. See what happens. Nowadays, there are potentially a ton of other models that you could potentially utilize for your stock selections, portfolio selections, etc. And for these reasons that I've popped up over here. These are the weaknesses of the model and the assumptions that have been debunked. So do take that with a grain of salt as well. Other than that, I do hope that you enjoyed this walkthrough / discussion on how to apply the Monte Carlo simulations with the efficient frontier. And I hope to see you in the next video. Thank you for watching.